Hi all, I am Apoorva. Welcome to one of my first video series on mutual fund categories in present Indian market. This video is a continuation of the first few video series in this investment one. I have provided the links to those on the video screen as well as in the description below. Do check it out. Here I would be talking about the debt funds category in more detail with examples and explanation. Please read the disclaimer at the end of each video carefully as mentioned before. So let's begin. What exactly are debt funds? The mutual funds which invest in fixed income or fixed interest generating opportunities such as corporate bonds, government securities, treasury bills, commercial paper, deposits and other money market instruments. The fundamental reason for investing in debt funds is to earn a steady interest income and market appreciation. The SEBI, Securities and Exchange Board of India, has capped the expense ratio of debt funds at approximately 2.25%. The risk categories are between little to no risk ratios. Debt mutual funds have schemes that fit almost any investment horizon, like liquid funds for example, for just a few days to 3 to 12 months, bond funds for 24 to 36 months, medium or long-term funds for 36 to 60 plus months, etc. So it basically suits both short-term as well as long-term investments. Debt mutual fund schemes will be charged capital gains tax. Short-term capital gains tax or STCG is applicable to capital gains earned on a scheme that's been held for up to 3 years at predetermined range of 10% to 37% depending upon the income slab of the individual. Long-term capital gains or LTCG tax is applicable for capital gains earned on a scheme that's been held for over 3 years at the rate of 20% with indexation or based on your individual tax brackets. Debt funds are more liquid than fixed deposits since they can be redeemed at any point. Fixed deposits have a predetermined lock-in period, and for premature withdrawals, you will either earn lower interest rates or be charged certain amount. When compared to a 5-year bank FD, debt funds offer higher returns and of course with its own set of associated risks. Now let us move on to the types of debt funds available in Indian market. As you can see on the screen, these are some of the various types of debt funds available in today's market. Low duration, short and ultra short duration, medium or long duration, money market or liquid funds, bond funds, etc. Now let us go into the details of a few of these fund types. Ultra short or low duration funds are those bonds which invest in securities that mature both before or after 91 days. Typically, the investment horizon for these funds range from a week to about 18 months. Hence, if you have surplus funds that you wish to park for 1 month to approximately 9 months and earn some dividends from it, then this investment vehicle is something to be considered. Moving on to short duration funds, these are debt funds that lend to companies for a period of 1 to 3 years. These funds are mostly invested only in quality companies that have a proven record of repaying their loans on time as well as have sufficient cash flows from their businesses. These needs to be considered for people who don't need certain amount for at least 12 to 18 months. Similar to fixed deposits but deliver comparatively better returns than bank deposits and also keep the risk under control. Moving on to medium duration funds, these are the debt funds that lend to quality companies for 3 or more years. They invest approximately 65% of corpus in debt and money market instruments and involve a moderate risk ratio at times. It is quite ideal for an investment horizon of 2 to 4 years or beyond. For people who are planning to buy a car, for example, will in the next 2 to 3 years would find medium or medium to long duration funds very apt. Moving on to long duration funds, these are the funds which invest in corporate bonds or government securities that have a long-term maturity period. People who want to invest money for longer duration like 5 to 7 plus years but prefer less riskier assets compared to the equity funds consider these kind of long duration funds. Moving on to liquid funds or money market funds. The entire point of investing in a liquid fund is to maintain a high degree of liquidity, that is, convertibility to cash or cash value in the investment. Usually, only very highly rated instruments are invested in through liquid funds. People who want to generate higher returns compared to their savings account and require a similar type of liquidity invest in these money market or liquid funds. Also, if someone is planning for a vacation with a goal of acquiring some amount in the next 3 to 6 or approximately 12 months, invest in these kind of funds. Bond funds or dynamic bond funds are debt funds which invest primarily in bonds, government, municipal, corporate or convertible, and other debt instruments like securities with the primary goal of generating monthly income for investors. The dynamic bond funds dynamically manage the lending duration. These funds allow the fund managers to use interest rate movements in the economy as an opportunity to generate higher returns. There is no or low minimum investment to purchase, no maturity date to hold for, so you can sell it at any time. There are a few other categories under debt funds which depend on the fund manager picks and the individual selections. With that, I'm signing off for now and I will meet you in my next video. Thank you.